Hey everybody, welcome back to another Toce Talk. This week we have our CEO, Andre Toce, joining us. How's it going, brother?
Hello. Going all right, despite the current market action.
Yeah, our friend Mr. Market isn't a big fan of Russian-Ukrainian conflict.
I guess not.
Or interest rates, I suppose.
I guess not. Mr. Market could be your friend or enemy depending on what day it is, I suppose.
Yeah, well, I guess it is important to remember he is some irrational,
Manic depressive.
yeah, depressive, manic individual.
Yeah. I like the saying, people like, the stock market is just a graph of rich people's feelings. Which is, one. To an extent it's true. I mean, over the long term, the old saying goes that in the short term it's a voting machine, and in the long term it's a weighing machine, meaning in the short term people are buying and selling based on their predictions of the future, but over the long term stock prices always end up being right around, they grow or fall about the same amount as
Their
the corporation's
fundamentals.
profits grow or fall. Yeah, so, Coca-Cola over the last 50 years or whatever, they grew their earnings times 30, and the stock is up 30 times. It didn't go straight in line, because in the short term, people will always say, "Oh, Coca-Cola's done. They're going to get swept away," and then, "Oh, Coca-Cola's great. It's going to be the next best thing," and then somewhere it evens out in the middle and starts to line up with earnings.
Yeah, so eventually the market will agree with the fundamentals of the company, and ultimately
Mr. Market may be manic depressive, but he is smart.
right.
So if you're right, market's smart, eventually it will agree with you.
Awesome. What about interest rates? So the Fed's been a lot of talk, having some rate hikes this year. What is that something to worry about or think about at all? Can you do anything to prepare, or what are your thoughts?
So interest rates. You hear a lot about that word generally, like what are interest rates right now? Technically, it's the money, the interest rate that Federal Reserve member banks borrow at. So
The prime rate.
the prime rate. So they borrow from the Federal Reserve, and then they lend it to you and me. So if their rate is higher, that means that they're going to charge us more to borrow. When interest rates are super low, we get the benefit of that as well. That's why mortgage, a lot of people refinance their mortgages over the past couple of years, because coronavirus happened. The Fed, did an emergency drop. Interest rates went to zero. They weren't far above zero before that, but they dropped them all the way to zero, and then everybody starts refinancing their mortgage because they're like, wow, I'm at 4% right now. If I refinance, I can get a 2.5% rate, and over a 30-year period, which is the typical mortgage, that can save you a lot of money in the long run. So everyone's always, Warren Buffett said interest rates are like gravity for stocks. Mm-hmm. High interest rates means I can put my money in a bond and take very little risk, and I get whatever the prevailing interest rate is. So when interest rates are low, it doesn't pay me to put my money in bonds, but as interest rates rise, it's more and more enticing to go ahead and risk off and put it in bonds and get a risk-free rate, as we call it. And then, of course, the opposite occurs when interest rates are super low. It's like, well, I'm not getting paid to save, so it pushes you out on the risk curve.
Right.
So you're going to take a little more risk. Maybe instead of holding cash or buying bonds, you buy stock. And so
Stimulates the market.
So low interest rates, basically, generally speaking, of course, human nature is unpredictable, but low interest rates should encourage people to buy stocks, and high interest rates should encourage people to save and sell stocks, buy bonds, or whatever.
But it doesn't always work out that way, because humans are unpredictable.
Humans gonna human.
Humans gonna human.
But I mean, overall, whenever we look back in time 10 years and have this zoomed out view, we see that those behaviors do pretty much fall in line with interest rates. But it doesn't. I guess this is always a point I'm trying to make to people: is it's not always so perfect and straightforward. It's not this. Law of the universe. It's more a general principle.
Mm-hmm.
But you asked if it's anything to worry about. First of all, there's nothing you can do about it.
Right.
So I usually try not to worry about things over which I have no control.
Wise bit of advice.
Mark Twain said, I've worried about a great many things in my life, few of which ever came to fruition. So we try not to worry about things you can't control, especially for the younger crowd. You know, we set out, whenever we start investing, before we invest that first dollar, we have a plan. We know what we're going to do with that money. We know how long we're going to leave it there. And I would say, you know, especially for young people, we buy and hold. We like to accumulate valuable assets and hold on to them for dear life and just let them grow and grow no matter what the circumstance. So it's not buy and hold unless interest rates rise. Right. It's not buy and hold unless there's a war somewhere in the world. It's buy and hold, period.
Right.
And if you buy right, you can hold tight. So
and right now, it's a good opportunity to
hold
reinvest.
Tight. Certainly better than buying yesterday or the day before. So if you're on this, if you have a financial plan, it almost definitely involves investing your savings. So if you get to the point where you're making more money than you're spending, well, you got to do something with the excess. Keeping it in a checking account, basically I say not to decide is to decide. If you want to leave it in checking, okay, but you've decided to put it in a place where it will not grow. And it will actually get eaten away by inflation, unfortunately. Mm-hmm. So if you're consistently investing your savings, then you were going to buy stocks anyway. So great, stocks are lower now. So your dollar saved is going to buy more of these great American businesses who are going to be here 10, 20, 30, 50 years in the future. So if you zoom out a little bit, you realize that even though it's psychologically unsatisfying to watch the value of your holdings go down, you weren't planning on selling them anyway. And in fact, you were planning to buy more, so this is perfect. They say the stock market's the only place where there's a sale going on and people run out of the store.
That's a great quote. Well, that was awesome. Thanks, AJ.
All right, no problem.
See you guys.
Well, see you later.
See you guys next time on Toce Talk.